Okay, great. Thank you all for joining our webinar series. Today, we'll be talking about underwriting judgment and AI-enabled workflows, and is co-hosted by BoundAI InsurTech New York. So thank you all for joining, and as more of you kind of join us, we'll kind of get started here. But before we get to the actual panel, just want to give you a quick introduction of our community for those who are not familiar with us. InsurTech NY, we have different programs to accelerate innovation and connect those in the ecosystem, whether they are InsurTech brokers, underwriters, carriers and brokers, technology enablers, associations, investors, and advisory people. And we do this through multiple programs such as early stage competition, InsurTech Match program, MGA Lab, different events that we're hosting, and we also make investments as well. And we host a lot of different activities throughout the year. As you can see, we host a number of different public events, including this type of webinar series. We also host small events throughout the year, like the one for MGA event, MGA content, and then distribution in November, and then also Spring Conference, which we'll talk about. But we also host a number of other activities that are typically reserved for specific programs like InsurTech Match, MGA Lab, or for carrier and broker members who's interested in innovation. One highlight that we want to make here is the InsurTech Spring Conference, which is our flagship conference that we host annually. I believe this is our 7th year doing it, and it'll be in Pier 60 in New York, March 30th, 31st. If you haven't registered already, please do so. We typically get over 1,000 people. I think this year will be way more than 1,000 just based on the registration. And we talk about the human side of insurance. There's a lot of talk about technology side, but we'll also be talking about what technology and AI has done to humans in insurance. And you know, there's still a lot of roles that humans need to do to make insurance function well. And there might need to be some adjustments that need to be made, but there's definitely a lot of different things humans are needed. And so we'll be talking about that throughout the conference. So please register if you haven't done so already. All right, now we'll get into the actual panel here. And so we have amazing panelists here, speakers, but I'll hand it off to David, who will be moderating this panel.
Thanks, Tony. Appreciate everyone who's joined today for the webinar on underwriting judgment and AI-enabled workflows. And you can kind of think of this webinar as like a pull-out or a call-out of our conference, having that balance between what humans have to do as underwriters and workflows that make their jobs, easier, hopefully not harder in most cases. So I'm joined by 3 excellent panelists today. Gabe from Tricura, which is a company in the medical professional liability space. And then Ted from Bridge Specialty, which is a wholesaler. He's in charge of digital distribution. And then Mladen from BoundAI and OIP InsurTech. So, with that intro, I think, really there's a few things we're going to cover. We're going to talk about, triage. We're going to talk about underwriting logic, and then, the future job of the underwriter. So I'll let Mladen kick things off, in talking about triage. So, you deal with a fair number of carriers, and, some of them have invested pretty heavily in, we'll call it like the precursor to AI, the data extraction layer. But when you actually get to like the next step, like we got all the data out of the submission, it comes to the triage. So where does that break when it's not part of the workflow? And, what does it cost, when you're trying to build this out beyond just a simple extraction?
David, that's a great question. I think that with new technologies, we got 2 big unlocks, right? There is the automation of the overall underwriting process and the back office operations, and then there is the decision support that AI can provide, and it's also accomplished with different set of technologies and modalities of AI. So what I think is the data capture as a challenge is still persists. It's a complex challenge when you are moving into more complex lines and scaled way of collecting and capturing information from documents or any other source. Where we are missing out with the data triage not being done properly is once we solve for this problem, we are at the position that we hold most of the information needed for the next steps, and they can be heavily reused. If we don't move to that decision support step, we are stopping at operational savings and missing out. We are working on expense ratios, we are working on operational ratios, but we're not pushing that data forwards to the underwriters who are market facing and not allowing them to efficiently underwrite, to capture more quality risk, because the triage itself, it's constituted of a couple of things. The rule-based triage that's based on guidelines, the scoring, which is usually done through a combination of several factors, portfolio management, and a couple of other things. And then we have the risk insight as well, which presented soon enough can pay a lot of dividends on the underwriting of the risk itself. So I think that's where we already paid the cost, which is the most complex part of it. Once we capture all that information, I think it's very important to move that deeper down the workflows and do the triage, but do it properly.
Yeah, so it sounds like really to get the full business value out of the technology investment, you definitely have to go further downstream than just extraction to really, risk assessment, portfolio management, and, analysis of, those individual decisions. And, I know there's some lines where, it's very straightforward to be able to do this because, the underwriting box is simple. But there's some lines where it's a lot more complex, like, in Gabe's universe, where you've had even some of the, most vaulted carriers, blow up their books of business because they chose the wrong skilled nursing facilities to work with. So, when you're looking at, submissions coming in, how do you decide what a clean submission looks like? And what's the signal that tells you a risk needs a person to come in beyond, what your initial AI or data tools are telling you?
Yeah, so appreciate the question. To your point, we do underwrite pretty complex risks and therefore have a pretty heavy human involvement in all of our submissions. What we leverage technology for is really to help facilitate a triage and risk scoring process that drives efficiency in our process and focuses the allocation of resources to the highest and best use. For example, underwriting technical to actual pricing delta is one of the things that we help to create automation around and rank that in order so that we can route submissions to the right underwriters and set priority as we take in submissions. It is important as well as we look at accounts. We see a lot of business, but the selection is really important, and just making sure that the human time is spent where it's needed most is a really important part of our internal process.
Yeah, so I just want to drill in on one point, and then we'll get to Ted. But you see a lot, but you don't accept a lot. What's your average, quote to bind ratio?
I would say it varies by state and by a retail partner that we're working with. But let's say in and around 20% would be quote to bind on a given month. And then in terms of submissions, we're easily turning away maybe 50% of what we see off the bat, just because of underwriting fit in terms of our box and what we're looking for qualitatively, as well as in terms of pricing, that there's alignment and what we believe to be actuarial adequacy. So I guess sifting through all of that, really, it's super helpful to have technology a part of that process.
Yeah, well, it's a pretty steep funnel that you have. So, Ted, being part of that, chain to get some of the submissions out to the right partners, it seems like getting to those either, right fit, right market decision is important, or, getting through underwriting faster is a benefit. How do you see, a better system impacting, the outcomes with retail agents? Is compressing time mean that you get, better decisions, or it just means that, your retail agents are happy because you're getting back to them sooner?
Yeah, it's interesting. I think that it's been a mistake to assume that faster automatically means better, right? So if improved triage just helps submissions move through a system more quickly, then all we've really done is compress the timeline. The same risks get declined, um, same ones get quoted, and the underlying economics really don't change all that much. So while we've improved responsiveness, we haven't really improved outcomes, which is ultimately what I think everyone in the value chain is looking for. So to me, where it becomes meaningful is when triage changes how attention is allocated across this system. Right, to go on uh, Gabe's example, a lot of broker and underwriting time gets consumed by low probability submissions today. Not because we don't know better, but because the signaling around appetite's imperfect, or the cost of being wrong is so high. So everything gets worked, even when realistically it probably shouldn't. So, if AI-driven triage can more accurately identify which submissions are viable and which aren't, earlier in the process, that's where you start to see a shift, right? Brokers are spending less time chasing status or pushing risks that may be more marginal, and more time shaping submissions that have a real chance to land. That means that underwriters can go deeper on fewer, better aligned opportunities, and ultimately it's when you start to see improvements in quote rates, conversion rates, and ultimately binding outcomes. So for me, the real question isn't around are things moving faster. It's are we spending more time on the right risks? So if the answer is yes, then speed's actually a byproduct of that smarter system. But if the answer is no, then really all we've done is built a more efficient version of the same process, which I don't actually think benefits anyone, retailer, wholesaler, or the carrier.
Yeah, no, I think this like whole philosophy goes back to like, Ellie Goldrat's the goal, right? Like you have to figure out what is ultimately your critical path here. And if you're, shortening something that's not the critical path, then it's not actually improving the system. And if you're not giving underwriters time that can be useful, then, it doesn't really matter. So, I think that's a pretty important distinction. So before I go back to, some of my pre-set up questions, we got a question from the audience, and I just want to make a point that like, the chat function's disabled, but the Q&A function is available. So, if something any of the panelists says is interesting and you have a follow-up, like, throw the question in there and, I'll do my best to incorporate it. So the question here is, could we talk about loss runs? What has worked versus what hasn't for experience rating. So I don't know, Mladen or Ted, if you had, comments on that about loss ratios or loss runs, sorry.
I can give a technical note in a sense that loss runs have been a persistent, difficult challenge because there is hundreds of thousands of loss run templates outside, and it has been traditionally very difficult to capture the information from the loss runs. But not just to capture it, but also to give it a proper structure and understand where the losses belong at which level of the risk. So today, with the newer approaches to capturing that information, it becomes much easier. We accomplished a lot with combination of technologies that work on loss runs, and that can be very easy to deploy in a sense of the experience itself. It's robust in the backend, but there is a lot that we can do today to capture that information much faster and with much more robust data sets that are coming out of the loss runs. So I think the technology is there, and now feeding that back into the experience rating and more advanced underwriting algos. I'll leave that to Ted as well, but it depends on multiple factors on how the rating process and the underwriting process is being set up. It comes down to a bit of a downstream situation as well.
Yeah, I don't have any real sort of practical thoughts other than if you look back from sort of InsurTech 1.0, talking 2015, 2016 to today, it does feel like the technology is where we need it to be to start tackling things like loss runs. There's been a lot of money, a lot of brilliant people that have tried and failed to do loss runs at scale for all the reasons Mon just called out. It's fairly straightforward to do it with a single carrier. But in our world, when we're dealing with hundreds of capacity providers a month, that's where a lot of the sort of prior iterations of this technology, old school OCR type tools, really showed their flaws. And loss ratios is one of those areas where you've got to be precise. There's no way around it. So it does feel like we're nearing the point where we can actually begin to ingest loss ratio data a lot more efficiently and begin to see the promise as it relates to how do we then put that into the submission process and the underwriting process to streamline that. Because up to this point, I would argue it's been a bit of a pipe dream at scale. Now there may be specific examples of a small number of capacity providers where we solve for it, but doing it at scale has been next to impossible before now.
Yeah, no, it's definitely good to see, the changes in the environment. I mean, we have a portfolio company in our fund called Deep Vector that has essentially built a tool that's been trained on, I think they're up to like 4,500 different carrier loss run templates. And I think that's like kind of the point that Ted made. Like, yeah, you can train it on like one. Like, if you're primarily working in a market with like 3 or 4 carriers, sure, it's going to be easy. But barring that, you really kind of need to customize it and build for all the different possibilities. Because I think ultimately, from a carrier standpoint, they don't want you to switch. So making loss runs really easy to ingest would actually be against their best interest, which is, I'm sure, not what a lot of people want to admit, but it's just a reality, right? Like, if you can keep a client because you add friction, then like, why wouldn't you do that? So it's just, I think, part of how the industry is set up. So I'm gonna bring back one question that I had, and then we have a few from the audience. So I'll come back to those. But the last piece I had for Mladen on Triage was you do a lot of these implementations within submission triage. Where do you see common mistakes that carriers make in implementation, and where maybe they've made a major update and then they decide to roll it back because something went wrong?
Yeah, a couple of things, and it's an interesting way you phrase it. But when something was attempted and rolled back, and that's actually what we are seeing a lot today. There is a lot of debt to be paid to the ways that the underwriting process, marketing strategies, guides, portfolio allocations are managed today. There is a lot of technology debt. There is a lot of process debt. And then there is this promise of these newer AI technologies, which were great on a shallow use case of kind of chewing on a lot of data and then providing some kind of a black box algorithm that just, day one, it provides something. And it's a good demo technologies usually. When they actually hit the production, we saw a lot of rollbacks because it didn't account for specificities of the way the underwriting teams like to select risks, on the ways that broker teams like to trade. It doesn't go deep enough into the expertise, which is already in the company, but tries to reinvent the wheel. So that black box approach works well for up to 30 days. After that, it has to be rolled back because triage is a sophisticated dance of kind of the way that the company sees a good risk, the way that an underwriter wants to see the insight on that specific class, on that specific risk, or kind of a cross-class situation. So that's one of the situations where we saw a lot of kind of let me do the underwriting job technology. On our end, what we are trying to do is be a good tool and a partner for the underwriting teams. And the second thing is, for a while, the data capture stopped at collecting what you're actually binding. What you're not picking up or declining sometimes stays away from that data capture and collection, which creates a bunch of problems later. So getting that sharp focus on every risk that hits the underwriting desk provided much yield later. If it gets neglected, it sets back the teams heavily. So that's our experience. There is, of course, more. It's a very interesting topic on the way that we are triaging the risk, but these are the top two that we are seeing lately.
Yeah, so maybe to pull an analogy here, right? Like the underwriter ultimately needs to have it in, the way that they think of it. So, since we're here today, St. Patrick's Day, I think I have my green on. If you're the leprechaun, right, you want to see the pot of gold in your box and be sure what it is, not have, an empty pot at the end of the rainbow. And I think allowing the underwriters to have that clarity and vision is what's critical to keeping it versus, just having, magic algorithm dust that is, painted along the rainbow. So, the next theme I want to talk about is, keeping the underwriting logic where it belongs and kind of digging into this next layer of detail. And maybe to start off, there was a question from the audience about, what is possible within, triage and selection. So the question is, we've been mostly talking about using AI for extraction to execute in deterministic rules. Or are we talking about actually leveraging AI for answering qualitative questions? And they gave an example of, there's no pattern of repeated foodborne illness or, premises liability claims. So maybe this is for you, Gabe. Like, are you able to use AI when you review, the electronic medical records to see, hey, these nurses are actually making sure that they give everyone their medicines? Or are you just kind of determining, hey, are they actually keeping records at all, and not go beyond that?
Yeah, well, we don't underwrite off of EMR data, and we also don't use generative AI in the pricing inference of our underwriting process. The models that we utilize are gated, self-audited, and have strict guidelines on what constitutes intended behavior. We also have a heavy amount of human input and transparency in our process to synergize human intuition and decisioning on how selection, structuring, and pricing are established. So we really try to make sure that there's multiple steps along the way where things are double checked. We have kind of transparency into the degree to which things make sense and are aligned to our intended behavior. And then also, although we can and we do have elements of qualitative assessment in our process, the ultimate decision is still with the human underwriter. So it's helpful context for us, but not necessarily the final word, if that makes sense.
Yeah, so it seems like from your perspective, sure, it is possible to make qualitative decisions, but because of the complexity of each of your accounts, you're just using it as a starting point to kind of organize the information for somebody else.
Yeah, and to maybe aggregate and surface relevant pieces of information that are maybe more important than others, because there's a lot to sift through. So, elements of that are a part of what we do. But at the end of the day, yes, we do end up making a human judgment call on all of it.
Yeah. So I think, what is also important around, where you're using this data is like where it sits in the value chain. So maybe, this one's for Ted, but, as a wholesaler, you see, the variation between what the retail agents want to be bound and what the carriers are willing to accept. Can you use the AI to make that clearer, or does it actually add like more uncertainty because the carrier has their own, AI model and they're, maybe telling you certain things, and then maybe the retail agent isn't, collecting information on a human level that, maybe their tools are gathering from the person. Either it's like voice AI or filling in data to underwriting questions without having asked the client.
Yeah, it's an interesting opportunity because clearly there's this like structural challenge in the wholesale market around carrier appetite and how it is so incredibly important, but often poorly expressed. And so, whether you're talking about appetite in the landscape of like formal guidelines or informal conversations, oftentimes it's past experiences, or going all the way down to individual underwriter judgment. We do spend a lot of time interpreting those signals and then matching the risk that we're looking at accordingly. So to that end, AI has the potential to bring a lot more clarity to it, right? It can take these fragmented and inconsistent inputs and sort of turn them into something more structured and more comparable. So in theory, it should make it easier to align submissions with the right markets and reduce a lot of the friction that exists today. And we actually have some interesting proofs of concepts that we've done that have proven that out really nicely. But it's a slippery slope. And so there's an important caveat to call out here, and that's that this is still very much a relationship-driven business, right? So as a wholesaler, we sit at the center of that dynamic. So our value isn't just simply routing this submissions. It's translating decisions. It's helping the retailer understand why something got declined, or why is this submission quoted on these terms, right? We've got to have not just a clear answer, but a credible answer. And so if AI is introducing appetite recommendations or decisions that feel more like a black box, you create a new kind of ambiguity, right? The answer might be faster, but it's harder to trust. And for our teammates, it's harder to explain. And that's a huge problem because these long-term relationships that we have with our retail partners are built on trust and clarity. So, particularly as it relates to underwriting and underwriting judgment, which appetite is a facet of, AI's got to go beyond accuracy, right? It has to be explainable. It has to be actionable. It's not a simple like binary, does this fit or not. It has to make appetite legible. It has to make brokers and retailers more effective communicators. And ultimately, it has to lean heavy on what has been for decades a very fascinating sort of corner of the academic AI world around explainable AI, which was XAI before Elon Musk launched XAI. And that interpretability is critical because in our world, certainly in Gabe's world, it's not a binary thing. There's judgment involved. And yes, AI can help make that more effective and more efficient, but that judgment remains, and those relationships are built on the trust that comes from being able to articulate that judgment and help walk a retailer and ultimately an insured through why decisions are the way they are.
Yeah, no, it sounds like it all really comes down to the implementation. If you implement it to take clarity out of the whisper down the lane, it'll work. If you implement it in a way where it's just representing black box answers, then it's going to make it worse. So I know we're at the half hour mark, and people may have only budgeted a half hour. So ultimately this will be recorded and we'll share it. But if the panelists can stay on for another 10 minutes, I know that we have about 5 or 6 questions in, from the audience, and we'll just shift to audience questions then. So I'll just kind of go down the line. It's not really necessarily in any particular order. But the first question we have is someone who's co-founded an MGA. He says that he's surprised by how little the AI was being used by the underwriting team, and it seems like a lot of the time and energy was just sifting through unstructured data. And he wanted to know, is that the norm? Is most underwriters, spending time with that? So maybe Mladen, since you're kind of the, before and after process guy, like, is that what you see when you go into most accounts at the beginning?
Yeah, you would be surprised. Yeah, so I do agree with the statement that there is so much work to be done on the unstructured data today. And Ted made a point a bit before this about all the ways that this information is coming in. It is still a challenge, but again, coming back to a paradigm of what that data is needed for, and that dictates the technologies that are available today, and most of them can solve the problem if you apply them to a proper challenge. So if we are looking to kind of get better at submission to quote step, right? Get more quotes out. Then working on unstructured data and structuring it into a usable data points, then forwarding that immediately to a rater while logging the risk into the core system through automation technologies that we use. That helps a lot for that particular use case. But then there is also a judgment call, an insight, and information that needs to be provided. For that, we need a different set of technologies to work on a lot of across, let's say, a lot of documents and provide the coverage gaps analysis to provide potential for the top 5 markets that might be most reactive to it if you're in a wholesale model like that is, or selecting the best pricing option. So the thing is, yes, it is still a problem. Yes, most underwriting teams are still sifting through documents and doing a lot of work on understanding the submission itself. But being mindful about what the actual problem we are solving and applying the right tool to it, I've never been more enthusiastic about our chances of solving all those problems. There is so much that these new technology that reads through all these unstructured channels of communication in our industry today does that. Most of it can be solved. It's just a matter of choosing the right partner and the right approach and being mindful about which goals are we tackling with the thing. That process is pretty complex, although it looks very simple.
Yeah, so it sounds like you have a huge backlog of people that want to work with you, but there's different levels of sophistication depending on one subset of the underwriting process you're starting with. So the next one we have is on build versus buy. So what's the panel's perspective on build versus buy given the advancement of quality AI coding tools? So maybe Gabe, if you want to take a shot at that one.
Yeah. Well, I think that a lot of that that decision has to do with where an organization's highest and best use is. There are certain problems that we find we experience, but many other MGAs experience similarly, in which case there's probably somebody out there that's built a really performance solution because their customer base is much larger than the value of the problem of solving the problem that we're looking to solve. And generally we're going to make a decision to buy that technology. Where we see an opportunity to build, and with a lot of the developments in the foundational models that everybody knows are helpful in building software, where that helps is where there's kind of super niche or kind of hyper specialized areas of expertise that are not necessarily universally applicable to other MGAs, but are super important for us. And that's where we would probably make the decision to build those solutions. So I guess it varies depending on the problem set and the universality of application. And that's kind of how we make decisions, if that makes sense.
Yeah, so you want to see who else is using it first, if their applications are similar to yours, and if it's going to be a complete solution, and then if that's the case, it might just save you time and money to jump into that one.
Yeah, as an example, the extraction of data from loss runs, we were talking about that earlier in the conversation, is something that is universally applicable to all MGAs and wholesale markets. It's likely a problem that somebody else has solved better than we would. So that's something that we would probably buy versus something that's a lot more specific to our use case and maybe not as commercially valuable to other parties. Would be something that we would build.
Great. So moving down the line of questions, it looks like this one's for you, Ted. So if retail agencies begin adopting AI systems that can consistently assess and pre-qualify risks at a high degree of confidence, do you see a future where wholesalers will just trust what they get and they don't need to do any, or they do minimal re-underwriting before they get it to the carrier?
I think directionally yes, you'll see less redundant work over time. So if retail agents are using approved or agreed upon AI systems to pre-qualify risks in a consistent and credible way, it should reduce a lot of the noise that flows into the channel today, right? That submissions will be better formed. There'll be clear alignment on appetite, fewer dead ends, right? And I think that's ultimately good for everyone. But I don't think it leads to a world of re-underwriting, right? The reason wholesalers exist isn't just to process submissions. It's to interpret markets, structure deals, navigate complexity across carriers, and that layer doesn't go away just because the front end gets smarter. So what I do think happens is that there's this shift where where the work happens and what kind of work gets done. If the retail side's doing a better job of pre-qual, wholesalers can spend less time rechecking the basics and more time on higher value activities like shaping the risk, positioning it in the right way to the right markets, negotiating competitive terms, solving for edge cases, etc. But there's also this trust dynamic here for wholesalers to truly accept retail generated output. There has to be confidence not just in the technology, but also in how it's being used. Is it being used consistently? Like I said earlier, is it explainable? Is it interpretable? Is it aligned with how carriers actually think about the risk? And until that's proven, which is going to take a lot of time, you're still going to see some level of validation in the middle. So I guess I'd frame it less as elimination of underwriting at the wholesale level and more as a compression of redundant evaluations of judgment. I think the work doesn't disappear; it shifts a bit. And candidly, in a business like ours, where relationships and accountability really do still matter, someone's always going to own the final decision and stand behind it. AI can inform that, but I don't think it replaces it.
Yeah, so maybe another interpretation of what you're saying, Ted, is like, it's a trust-based business. So the AI might just either shorten the time that you can generate trust with a retail agent, or if you trust them on some things, it just expands the ability for you to see more of what's possible to trust them on.
I think the risk that I always fall into in these types of conversations is when you talk about the wholesale market, that means everything in our world, from non-standard personal lines auto all the way up to highly complex multi-billion-dollar cat property towers. And so there's certainly examples across that value chain where this is going to be more and less relevant. All you need to look at is the insurers who have automated underwriting more effectively than others. They're on more of that sort of high flow personal lines, smaller account type basis. And if you look at what large mid-market and above commercial lines carriers like an AIG are talking about from an AI perspective, it is much more around decision support versus judgment. And so I think the core of my response is really focused on that traditional open market brokerage, highly complex wholesale placement versus a Main Street business owner's policy, which certainly I think there's maybe more near-term opportunities for more automation in that placement.
Yeah, no, definitely. So final question, and then we'll wrap up. So I'll give you this one to Mladen to lead, but the question is, what are some use cases in production that are based off of generative or agentic AI? And what were some of the challenges that came in to move from proof of concept to production?
Oh yeah, it's a very good question. So it all comes back to the value to a proper distribution channel or to a proper carrier. And what I think is what both Ted and Gabe said is that a lot of the secret sauce usually lies in the niche use cases, that kind of a unique differentiator, the way that you're looking at risks, selecting risks, potentially dragging in third-party information and enriching it, giving a better product to the market. Everything around it, most mature use cases obviously are collecting the risk information and, let's say, automating the risk clearance, ingestion, collecting all that information, working across complex statement of values, border reports, anything that is that is complex to collect, gather, and understand, but provides a lot of dividends down the road. So you have that. What I like to say, and we said it a couple of times, is looking at it as a bow tie. So just collapsing that cost of collecting information, ingestion risk, that's usually paying immediate dividends. It has an ROI of 6 months. So it's very fast and produces a lot of value. But when you collapse that, it opens up a lot of different use cases on quote comparisons, risk exchange, in building internal risk exchanges where you're actually navigating your underwriters, brokers to a highest likelihood markets. So those are also becoming very mature use cases after you collect that data properly. So what I would say is complex data collection is now getting the most word of mouth, and it stays. So that's the technology that actually has a high retention ratios. Whilst once we collapse that, then we start opening up for more use cases which are working on quote to bind ratios, or working on other more market facing metrics. This is where we see these quote compares, policy checkings, bind and file audits in that post-bind workflows, or kind of market outreach technologies and the risk exchanges, even portfolio underwriting, which is an algorithmic, which is getting a lot of good use cases today for some of the carriers who have been successful deploying it. So it is a double-sided thing. So this is what we see in the market today.
Yeah, I mean, it seems like you really captured a lot of use cases all the way from, just simple data processing all the way down to, judgment and placement type of work. So that's pretty much all the time that we have today. So I want to thank everyone for attending. I want to thank Ted, Mulata, and Gabe, and just remind you, we have the InsurTech Spring Conference coming up March 30th and 31st. So I know, a few of our panelists will be there. Tonya will be there. So hopefully everyone can join us, and looking forward to seeing everyone there. Thanks.